How's it day, guys? Hope you're having an amazing day and ready for part one of risk management. Again, I suggest you're getting your books out, take some notes. I think this is a very, very important section. Probably one of the most important sections out there in terms of your trading career, in terms of this program. It's definitely something that you need to get down. To get out of this section is basically identifying what risk management is, what it will look like, how does it benefit you, the different types of risk management, how risk management works in terms of managing trades, and then just the basic setup of how it actually looks, how to calculate your lot size, how to execute correctly in terms of your lot size and the count size that you have, and what you want to risk. So the part one is basically just going to be breaking down what it is, what and why is it so important. So first thing, as you can see, part one of risk management. What is risk management? Now there's a couple things. Capital preservation, right? I'm going to go into each little section now. You don't control the outcomes, you control your risk. Strategy without risk management equals gambling. Profitable traders think in percentage, not money. These are the four main things that you need to understand. So when we talk about capital preservation, is something that we deeply need to understand. Without capital, your trading account's depleted, you're going to be making no money, right? So by utilizing risk management, you are keeping your capital in a safe area. But this doesn't also mean having the last 10 grand that you have in your bank account and depositing into a broker and then still applying risk management. This still means being risk diverse, and this can be in trading accounts. As you will see later in the program, there'll be diversifying your capital that you're utilizing into funded accounts, personal capital, investments, etc. And this is a great way to protect your capital, not just to preserve it, to grow it, but to protect it. Risk management is very, very important, and you'll see how we utilize this not only in our day trading, as I said, but also in our investment plans and our financial goals. Without risk management, your capital is really just going to get depleted. You're going to see bigger losses than you're supposed to. You're going to be risking more than you actually wanted to, especially if you come to the scenario of using 10K into a broker and you're losing it all, and that's the last little bit of capital that you have. So, capital preservation with risk management is vitally important. So, what I would suggest you do in terms of just this little section is understand how much capital you have to utilize, write down your goals for the year, and then speak to myself or Zach in the best way possible to utilize that capital that you've set aside for trading/investing, what would work best for you, and also just understanding yourself, what goals can you accomplish with the capital that you're actually working with. So very, very important section. I'd say write capital preservation, write some goals down, write what you have, and then let's have a chat. Okay, next thing. You don't control outcomes, you control risk. Now, basically, what this looks like is without risk management, you're going to be taking greedy trades, you're going to be over trading. You're going to be revenge trading. You're going to be taking trades that you shouldn't be at all. You're not going to understand your limits, unrealistic expectations. And these are things to understand, right? Because, of course, yes, you can risk 20% on a trade, but you can't guarantee that that trade is going to go in your direction, right? That's something to understand. But what you can control is your risk. Remember, when it comes to trading, even investing, it's all about probability, putting probability in your favor by utilizing the trading strategy that we've given you, applying it correctly, right? That's super important. And by applying it correctly, your executions, your risk, everything will be on point, and it leads back to, again, capital preservation. So we need to understand that we cannot control outcomes, we can only control the risk, right? The next thing, again, strategy without risk management equals gambling. As I was saying, if you are risking 20% of your account to make, let's say, 60%, whatever the case may be, the probability is not going to be in your favor. You need to have a massive win rate in order to actually succeed, especially if you're risking above the 1.5% mark or even 1% mark, right? Without your strategy, without having proper trading plans in place, you're going to see that again, capital preservation, your capital is going to deplete. You're going to be taking trades that you're not supposed to because your risk management wasn't intact. You're risking more on a trade, which leads to revenge trading. There's a lot of things you'll see that all of these things tied to risk management, and that's why it's one of the most important sections in our whole program. Profitable traders think percentage, not money. This is a big topic as well. A lot of traders, and maybe it was you as well, are setting goals. Hey, I put in 5, 10 grand into this trading account. I am wanting to flip it to 10K. Now, usually in a 10 to 1 span, you are aiming within a month or at the least the shortest period as possible to try and reach this goal. Right, at first, maybe you have a risk management plan, but then the second trade just goes out of the window because you have set a monetary figure goal, right, with a lower capital end. If you're trading with 200,000 Rand, that's only 5% makes a lot more sense. That's why thinking percentage, not a monetary figure, really, really does help because you don't have to put yourself in a position to risk more to make more. It's all about having larger capital to risk 1% to make 3%, right? And by thinking in this direction, you can actually keep hold of your strategy, your trading plan, your risk management. You're not going to lead yourself to taking wrong trades, revenge trades, greed, etc., etc. Yes, there's still factors that can play into that, but automatically applying a risk management plan is going to set you so much further than the most average traders. So start thinking a percentage and not a monetary figure, because if you can do that, you're going to be again above the average, and making money makes a lot more sense to you at a lower risk rate. It's not a percentage problem, it's a capital problem. Keep that in mind because we're going to get into that in the next little section here. So, why is percentage better than profit goals? Well, I just took a little two scenarios here that we'll get into now, but where traders fall short, having a profit goal in mind that is over 10% gain on a monthly basis. Street traders, they are not gunning for 10% on a monthly basis. In some cases, yes, the stock does really well, but their goal is not to hit a profit target of a monetary figure, but also protecting their capital as best as possible. If you set such a big goal out of a 10% on a monthly basis, and if you fall short from it, you're going to try and trade till you get to that point. It's all about how the market's moving, etc., etc., right? So to cut it short, 10% gain, over 10% gain on a monthly basis is where a lot of traders are falling short. And a lot of you guys are targeting 100%, 1000%, especially on these smaller capital. So, and that leads into the next thing, trading with capital that you can't afford to lose. So you can't afford to lose it. You take a 10% loss to try and make 10% gain, and then you start flipping the script and you start leading to, again, what? Revenge trading, losing more capital, etc., etc. Right? So trading with small capital and trying to flip it ties in with this capital that you can't lose. You're trying to make money too quickly. You're trying to trade with small capital, flip it. You're aiming for over a 10% gain on a monthly basis, focusing on trying to win every single day. You will understand, especially with this program and what we'll teach you, that most of the time we're actually sitting on our hands. And if we do take a loss, we're gathering the data and see where we need to improve. Not every day is going to be a winning day, right? We need to understand that. But by controlling your risk management, those winning days do not hurt as much. If you're losing 10% on a day, of course, that's going to hurt. If you're losing your funded account, which is usually 6 to 8% in a day, you're going to hurt. But if you're risking 1% and you step away from the charts, it's a much better feeling. Not trading with a trading plan, do not understand risk protocols, creating live capital with the expectations that you will make money. Where we want to. Risk management protocols understood. Trading with capital that is advised, following a trading plan, following a roadmap plan, full understanding of strategy, full understanding, full understanding of percentage over profit, monetary figure, utilizing funded accounts to scale if your capital is not big enough to trade with, right? Why does this matter? Building a risk management plan. Now, I took two scenarios, and the scenarios are very much similar, but based off experiences that I've had, not just myself as well as Zach, but also a lot of you guys, talking to thousands of you guys on a daily basis, as well as new guys that have joined us on the consultations, etc. So I took a scenario of a trader trading with 10,000 Rand and a trader utilizing the 10,000 Rand. You see the difference there. Trader trading with the 10,000 Rand and trader utilizing a 10,000 Rand. Now, in this scenario, it is not based on investing. It's just based on the day trading aspect of things. So if we can take a look at the trader trading with the 10,000 Rand, trader puts in 10K into the broker. Win rate is 40%. Trader wants to make 10K in a month. So that's what 100%. And that's usually based off what most guys want to do. They want to double the cash because they're trading with a small capital. They want to double the cash. They want to make a little bit of money because realistically, 2, 3 grand is not much nowadays. So 10 grand, 5 figures and up is when we start to feel a little bit better. Obviously, depends on your circumstances, but most of you guys that have joined us are, well earning over this, right? Risk per trade is 20 to 30%. 10 trades, equity curve. Okay, so now we're going to get into all of that. The outcome. Trader puts in 10K, risking 20 to 30% per trading scenario. Let's just say, hypothetically, the first trade was a 0.1%, 1% risk, a 2% risk. But then because he's trying to reach this goal in a month, he can't necessarily be risking 1% because it's out of a 10 trades ratio, right? Scenario, the trader starts at 10K. Let's just look at the equity curve. So trader results change and a percentage and account balance. Start with 10,000 Rand. I don't know why it says dollars there. Lost the first trade. Again, hypothetical. And you're going to see this exact same scenario with a guy with a risk management plan. Win 60%. Cool. He's back up. He's 11,200 Rand profit. 17,920 Rand profit off another 60% win, risking 30% to make 60%. A 1 to 2. Loss takes 4 losses in a row. 12,500, 8,781, 6,147. Loss 4,303. Win 6,885. Win 6,885. 11,016. And then what we can see here is that the trader is not depleted account necessarily, but risk 40% on his trade because he's finally made a little bit of profit. And remember, he's going through a psychological point of risking 30%, wins 2 trades in a row, is almost at his 20K mark or his 10K profit mark, but then starts to lose. So he risks another 30% once that point happens, gets a 60% gain. But now because he's 1,000 Rand up and he's been at a point where he was at 6,000 Rand, even 4,000 Rand left in the account, he risks 40% and he gets back down to 6,000 Rand, which inevitably the next trade he'll probably risk the whole account, and that's when it gets depleted. So, but again, it's only out of 10 trades. So he ends off the account at 6,610 Rand. The teaching points out of this is trade 1 to 8, standard risk of 30%, huge swings, heavy drawdowns. Trade 9 to 10, oversized risk to recover, account decimated. Lesson, high risk plus emotional decisions equals account destruction. Even with winning trades, this equals gambling, right? Why is the emotional decisions and high risk equal account destruction? Well, again, it comes down to making profit, feeling good, feeling egotistical because you're hitting 60% gains on a trade or 30% 60% gains on a trade, and then you're literally losing it in a trade or 2 trades straight after that, and you find yourself going to drawdown because you're risking too heavy, right? So emotional decisions, over trading, over risking. And this is giving him the benefit of the doubt that each trade he took was on a different day. Okay. Most guys in this case scenario, from what I've experienced and chatted to, they're up, then they take another trade, they lose, and this can actually happen in one day, right? And if this has happened to you, this is why we are going through this little section and why it's so important for you to listen. I know you might know a little bit about risk management, but now I'm putting into perspective for you. So, exact same scenario, but trader utilizing the 10,000 Rand. So, trader buys 3 funded accounts. Let's say the average of the accounts is about 3,200 Rand. It as he buys three $25,000 accounts. Win rate is exactly the same at 40%. Trader wants to keep risk management to make 1% to make 3% per trade. Risk per trade is 1%, 10 trades in the equity curve. The outcome, what we can see here, already much better. Now let's go into the stats here. Start off with the $25,000, right? Loss minus 1%. He's only down $250, but gains it and gets to $25,000, $492. $25,492. right? He's up about $500, up 2%, right? Plus another 3%. Again, same scenario where it's a loss, win-win. Traders up here. The trader's heavily up at this point, $1,257 that he's up. But then he goes on a little bit of a losing streak, exactly the same, risking 1%, 1%, 1%, 1%, eventually gets down to only $222, right? 4 losses in a row, and we are still profitable after hitting 2 wins. So that's 1, 2, 3, 4, 5 losses and only 2 wins, but yet his account's still profitable. Next 2 trades, exact same scenario, losing 4 trades in a row, account's almost depleted, but then takes a little win, right? A win, gets it up to $979 profit, then $1,758 profit, right? So now, then he takes another little loss on the 10th trade, gets to 1,000, let's round it off, $1,500 there, right? Let's go $1,500. Okay, $1,500. If we base that off his equity curve, we can clearly see it's quite good. Excuse me for my drawing. I had to draw this hand, but it looks pretty decent in my opinion. 25,000, it goes under. Equity curve is smooth. Can we see that? It's running higher just off 2 trades. Has a slow fall, even after 2 trades, still above this first trade, second trade mark. Then starts to drop. But again, still profitable, hovering over that $25,000 balance. Then rotating to the top side and eventually cutting off profits at that. Now, where the trader is utilizing the 10,000 Rand instead of the trader with 10,000 Rand, yeah, he's down 4,000 Rand, where this trader focused on percentage. Now, again, this is not the percentage we're always going to gun for. This is about 6% on the account that the trader made, which is again percentage over profit. Maybe he was targeting 7% here, but then took a little loss and was happy with the payout. 6% comes to 24,000 Rand profit. Now, the scenario was also based off that the trader buys 3 fund accounts and fails, passes 2, right? So then we can even double this to 48,000 Rand in a single, same scenario, copying the same equity curve, same trades, but just with proper risk management, we can see that this is way, way better up, right? But even if he didn't pass 2 and he only passed 1, we can still see that he's basically made his money back 2 times over because the cost of the accounts costed him, let's say, 9,800 Rand. He made his money back and he made 14,000 Rand profit pretty much off that account, right? So that is the most important thing. Just understanding that risk management can help you in many different scenarios, but it's not just about how much risking 1%, but utilizing and your capital, again, capital preservation, utilizing the capital you have in the best risk management plan, creating plan, investing plan, start exercising higher gains with a lower cost ratio, right? And this is basically what had happened. We 14,000 Rand up on the exact same equity curve, exact same scenario. So core rules that we can take away. Capital equals business inventory. No capital, no trading. Right? Capital is important. Capital preservation is important. Trading plan is important. Risk management plan covers all of that, and that's why it's so important. One bad day should not end your trading career. Core rules. Never risk more than 1% to 1.5%. The reason why I say this is sometimes on challenge accounts, you'll see myself risk 1.5% and sometimes 2% on a challenge account, but I'll never risk more than 1% on a pass phased account. And this can even be utilized in my personal account trading as well. Most times it's not a percentage problem, it's a capital problem. I'm going to keep on saying this, right? Core rule: do not revenge trade and have a trading plan and risk management plan. Okay. So this is part one. I hope you understand a little bit about what I am talking here, what I am going over, because it's super, super important to understand just the basic frameworks of how risk management can look, why it's good to have one, why it's not good to gamble, because inevitably you're just going to lose. The house always wins if you're gambling, and why this can make you a lot of money, but also save you a lot of money too. So, lesson for you guys, a bit of a visualization for you. And the thing is, we can go very, very deep into each little section. We can go deep into the theory of risk management and give multiple scenarios in terms of other investors and traders. But this is just the basic one. We're going to go over a little bit more in part two, and that's just how to calculate your lot size. And then part three will be mitigating, managing risk in actual trades. So, yeah, hope you guys enjoyed part one and grab some water, and we'll get into part two.